So what if the force that keeps the planet spinning in orbit is the exact same kind of force that drives the stock market? I know, it sounds a little out there, but a really fascinating new theory suggests that Isaac Newton's laws of motion don't just apply to things flying through space. They might just explain the entire dynamic dance of our economy. Let's dive in. But, before we can really get why this idea is such a game changer, we have to talk about a fundamental problem, a real crack in the foundation of how we usually think about economics. Just think about it for a second. Traditional economics is fantastic at describing a market in what's called equilibrium. That's a perfect, balanced moment in time. But it's, well, pretty bad at predicting how that market is actually going to change or evolve or move. It really struggles with the dynamics of it all. Okay, here's a pretty simple way to look at it. Traditional economics, it gives us a perfect photograph, a totally static snapshot of the market at one single moment of balance. But the real economy isn't a photo, is it? It's a full motion video. It's all about flow and change and momentum. We don't just need to know where the market is right now. We desperately need to predict where it's going. And what's funny is the early economists, guys like Adam Smith and Alfred Marshall, they talked about forces all the time. They totally had the right gut feeling. But here's the catch. They never actually defined what an economic force was. It was just a metaphor, and that left economics stuck in that static photograph. So how do we get the video camera rolling? Well, this is where the Newtonian insight comes in, and believe me, it solves this whole problem of dynamics in a way that is just surprisingly elegant. Now, people have tried to apply physics to economics before. It's a really attractive idea for sure, but pretty much every single attempt just fell flat. They were all missing one absolutely key piece of the puzzle. They all started from the same logical, common sense assumption, and that assumption turned out to be completely, totally wrong. The big mistake was assuming that the economic force was simply the price. I mean, it seems intuitive, right? A super high price feels like a strong force pushing back on you. But this idea, it leads straight to a dead end. It just doesn't create a workable dynamic system. And here it is. This is the big breakthrough. The economic force isn't the price itself. It's the rate at which the price is changing. Think about it like this. It's not the high price of a concert ticket that's the force. It's your burning desire to bid that price up. It's that urgency you feel to make a deal right now. That feeling, that is the force that actually moves the market. Okay, so once you make that one crucial shift, once you define force as the rate of change of price, something incredible happens. All of a sudden, all of Newton's other concepts, things like momentum and velocity, they just snap perfectly into place, creating a whole new dictionary for understanding economics. This is basically our economic Rosetta Stone, so let's walk through it. Position in physics is just where something is. In economics, that's your account balance, or the quantity of something you have. Velocity, how fast things are changing. That becomes the flow of goods into your shopping cart. Momentum becomes your personal price, the value you place on something. And, like we just saw, force is that powerful want or desire that makes you act. All right, now that we have the dictionary, we can take Newton's 3 famous laws and apply them directly to the marketplace. And what they show us is pretty amazing. So we're going to look at the law of inertia, the law of motion, and the law of action-reaction, but through this new lens. We're talking about freedom from want, the dynamic law of demand, and the principle of action and reaction in every single trade. So let's start with Newton's first law. An object in motion stays in motion. In economics, this means your natural state isn't just sitting still doing nothing. It's maintaining a constant routine, like buying your coffee every single morning. As long as nothing changes, you just keep doing it. In this state, you're force-free, which in our new language means you're basically free of want. You don't have any urgent desire to change your behavior. Now we get to the real engine of the market, Newton's second law. In physics, force equals the rate of change of momentum. So in our economic language, your want equals the rate of change of your personal price. Think about that. Your intense want for those concert tickets is the force that drives you to frantically raise your bid. That change in your personal price creates an acceleration. It sends a signal to the market that more goods need to flow. This is the law of demand, but now it has a powerful predictive motor behind it. And of course, Newton's third law. For every action, there is an equal and opposite reaction. This is the law of interaction, right? In economics, it's simple. Every transaction has two sides. For every single force of demand, there has to be an equal and opposite force of supply. The really deep idea here is that value in exchange is always conserved. It's a perfect balance. When you buy a coffee for $5, your desire for the coffee was just slightly greater than your desire for the $5. And for the barista, the opposite was true. Your personal price went up because you gained a coffee, and theirs went down by that exact same amount. The system stays perfectly balanced. Value isn't just created from thin air, it's transferred. And the beauty of this whole framework is just how clean the math is. The entire complex dance of the market, every buyer, every seller, all interacting, it all boils down to the same kind of math that describes how two planets pull on each other. It's a system of just two core equations that creates a simple, powerful model for something we always thought was just chaotic.
And this brings us all the way back to Adam Smith's famous paradox of water and diamonds. Water has immense value in use. I mean, we need it to live, but it has very little value in exchange. Why? Because that force or desire between a buyer and a seller is super low. Newton's third law shows us that the market doesn't really care about how useful something is intrinsically. It only operates on that value in exchange, the perfectly balanced forces between two people making a trade.
And that leads us to a final, really powerful thought. If this model is right, if the economy truly operates under laws of motion, then every market crash, every bubble, every weird anomaly, it isn't just random chaos. It's the effect of a force we just haven't identified yet. It completely transforms economics from a study of states to a search for forces. So the question is, what's the next force we're going to discover?